All right, let's talk about Good Times Restaurants, ticker GTIM. They just dropped what looks like a pretty disastrous earnings report, but the stock actually went up. So how on earth does that happen? That's what we're going to unpack today.
Yup, you're seeing that right. A 4% jump on the day they announced all this bad news. And this is just a perfect example of how Wall Street works, right? The market doesn't really care about what just happened. It's all about what's going to happen. Investors were looking past the ugly numbers and betting on a comeback. So let's figure out why they were so optimistic. So how did management pull this off? Well, they played it smart. They came out with what I'd call a reset and rebuild story. They didn't try to sugarcoat anything or make excuses. They just owned the bad quarter and then immediately pivoted to their turnaround plan. They basically told investors, forget about Q4, that's in the rearview mirror. Look at our roadmap for 2026. And this came straight from the top. The CEO, Ryan Zink, did not pull any punches. I mean, this quote says it all. It's about taking full responsibility. And that's just a masterclass in investor relations. You rip the Band-Aid off, admit the problem, and then you spend the rest of the time talking about the solution. That's exactly what Wall Street wanted to hear. But before we get to that comeback plan, we really need to understand just how deep the hole was they were digging themselves out of. So let's get into the actual numbers, because, wow, they weren't pretty. Let's start at the top. Revenue, $34 million. That's down more than 5% from the same time last year. And the main culprit, according to them, just not enough people walking in the door. Soft customer traffic, that's a killer for any restaurant. But here's where things get really ugly. We're looking at Adjusted EBITDA now, which is basically a snapshot of their core profit. And yikes, they went from making $1.3 million last year to actually losing money this quarter. So it wasn't just that sales were a little weak, their entire profit engine just completely stalled out. And this wasn't just a problem at a few locations. We're talking system-wide weakness. Same-store sales, that's a super important health check for restaurants, were in the red for both of their brands. Good Times was down almost 7%, and even their Bad Daddy's chain was down over 4.5%. Nowhere to hide on that one. So what went so wrong? Well, it was kind of a triple whammy. You had fewer customers coming in, you had ground beef costs going through the roof, and on top of that, labor was getting more expensive. This all leads to this nasty little thing called sales deleverage. Think of it this way. Your rent and basic staff costs are fixed. When your sales drop, those fixed costs suddenly become a much, much bigger piece of the pie, and it just demolishes your profit. Okay, so that's the problem. Now for the solution. Management laid out a pretty distinct plan, treating their two big brands, Good Times and Bad Daddy's, as totally separate challenges. Let's break down the playbook for each of them. First up, the Good Times chain. Their game plan here is all about getting back to their roots. They're launching this Colorado Native Burgers campaign to really lean into that local vibe. They're also getting smarter with marketing, shifting money into streaming video ads. Operationally, they're moving to a true cook-to-order system, a big quality boost. And maybe most importantly, they're saying no thanks to a price war. No huge discounts, which is key for protecting what's left of their margins. Now for Bad Daddy's, it's a totally different approach. This is all about refreshing the menu and being really smart with pricing. They're adding stuff like a Mediterranean power bowl to bring in customers who might not want a giant burger. They're also starting a Burger of the Month program to get people excited and coming back. And on the price front, they're not doing a big hike, just a tiny targeted increase, about 1.7%, to help with costs without freaking anybody out. All right, so that's the playbook. Looks good on paper, right? But talk is cheap. A plan is just a plan. This next part, this is the pivot. This is the exact moment in the earnings call where they gave investors that little glimmer of hope that sent the stock moving. And here it is. The magic words. Management said that in the first couple of weeks of the new quarter, things were already getting better. Sales trends were improving. They called them green shoots. And that little nugget of information was everything. It was tangible proof for investors that maybe, just maybe, the worst was over and the turnaround had already started. And they didn't stop there. They guided for that improvement to continue through the first quarter. Plus, they're backing it up with smart policies. They're not going to jack up prices for at least 6 months, which should help win back some goodwill. They're watching their corporate spending like a hawk. And they're getting a little bit of luck. Beef prices are finally starting to come down, so a few tailwinds at their back. Okay, so to recap, a disaster of a quarter in the past, but a hopeful plan for the future. So what do we make of all this? It's time for our take. This is the next call, where we give you our analysis and rating.
This really is the million-dollar question, isn't it? You see the terrible results, but you also see a clear plan and those little green shoots of hope. Do you buy into this turnaround story?
Here's where we land. Our rating is market perform. Look, the story they're telling is a good one. We love the honesty from management. But a story isn't the same as results. The risk that they can't actually pull this off is still huge. I mean, the restaurant business is a knife fight. So for us, it's a prove-it situation. We need to see the numbers in the first quarter before we can get any more excited. And to put this all in perspective, just look at the damage. Over the last year, while the S&P 500 is up over 15%, GTM has gotten chopped in half. That is some serious underperformance. It really drives home the two sides of this coin. There's massive risk here, but if they can pull this off, the potential upside is also pretty significant.
So what's the trade? Well, we see this as a pure speculation, a bet. This is not for your retirement account. It's a high-risk gamble that those little green shoots they talked about blossom into a full-blown beat-and-raise quarter. You're betting on one thing and one thing only, that management can actually execute their plan. Everything is going to come down to that next earnings report. That's when we'll find out if this is a real turnaround or just a dead cat bounce. And of course, just a reminder, we're breaking this down for you, but this is not financial advice.